Voice. This is from the IIFL Invest India Conference. We have with us Venkatesh Sanjeevi of Pictet Asset Management. Venkatesh, thank you for joining in. Good to have you on the show on a very interesting market day, actually. Now, what have you made of all the recent macro headwinds that we're talking about again here in India? These are real headwinds. We're talking about the rupee at 71. We're talking about crude oil prices heading back to 80. We're talking about the current account deficit maybe even widening. Your thoughts?
For about 3 or 4 years, till 2017, India had a very favorable macro environment. Crude being benign, inflation being low, fiscal deficit improving, current account deficit also improving. But clearly, the last few months have been more challenging. Crude has been a big reason for this. Fiscal deficit in India also has increased, and so has the current account deficit. So clearly the environment is more challenging, but at the same time, is it something which is extremely worrying, or is it catastrophic? And the answer is no. So I think it's still within the manageable levels, not as good as what we saw a few years ago. It has weakened a bit, but it's not at the place where it is unmanageable.
Okay, by the way, the move on IRB is getting now big. It's in fact down about more than 10%. That temporary freeze was hit on that, and after that it's now trying to recover. Let's see if that recovery sustains or not. But there was a bit of a temporary freeze that you had on that, of course. But Venkatesh, good afternoon. We have seen that money is moving out of emerging markets into developed markets. That's been the anecdotal evidence. So how are you positioned on India?
We run an India-focused fund, so we don't try to move money out of of the Indian market just because of these kind of macro changes. So we are invested in India in Pictet India fund. Within the fund, we would take tactical calls between different sectors and different stocks, but we are focused on India itself.
Okay, so are you looking to add more to the pharma or the IT space? That's the question. Given this rupee weakness, is that a way to perhaps play it? Are you intrinsically positive on these sectors as well?
Many of these stocks in these sectors you mentioned are fairly valued, or in some cases you can argue they're on the higher side of fair valuation as well. So we are very bottom-focused investors. If we find some interesting stock ideas across these sectors, we would add. But to be honest, in both these sectors, after a very strong run-up, I would think valuations are full in many of the stocks.
Would you say it's the same about the consumption stocks as well?
Well, consumption is again one sector where valuations are on the higher side. Some stocks are trading at multi-year high PE ratios or price to book multiples or things like that. So again, we are bottom-up investors. Wherever we find selective ideas, we would invest. But by and large, the consumer staple space is on the pretty expensive side.
Okay, that means that you're not too happy with valuations there. I mean, do you have current positions, or would you not look at buying fresh perhaps in consumer?
We do have some holdings within a consumer staples space. For example, we do have Imami and we do have ITC in our portfolio, where we feel that the valuations are on the more reasonable side. But few of the other stocks in the sector are quite expensive, so we are staying away from them.
Okay, it's a big space, of course. So perhaps there may not be a straight answer, but your thoughts on the mid cap and small caps and the kind of move that we have seen.
We have been kind of staying away from many of the frothy or expensive mid caps and small caps for a while. This actually has been a view for maybe close to a year. It did hurt us towards end of 2017 and early 2018, but after this correction, it has helped us quite a bit. At this point of time, I would say that valuations have corrected significantly in the space after, let's say, a 30–40% correction from the peak earlier this year. So it is looking more interesting than it did a few months ago. It is possible to find more interesting, reasonable ideas in the space now than it was earlier this year.
Okay, so where are these ideas? Some hints? I mean, I don't know, you can't take stock names maybe, but what is it that you're liking or scouting around in mid-caps?
Of course, I mean, we have been finding more opportunities now compared to 6 months ago or maybe 9 months ago, and we are looking to action any of these things.
Okay, and where do you see the key risk to the Indian equities now?
The macro environment with crude going up and the currency depreciating has got its own side of the risk element. The big event, of course, is the elections, which are due early next year. So we'll have to wait and watch how that event pans out. So that could be a significant event risk in the near term.
Okay, Venkatesh, are there any sectors that are a complete no-no for you in India right now that you'll absolutely want to avoid?
Again, we are pretty bottom-up investors. We don't really take a call on a sector saying we'll avoid the sector or not avoid the sector. Like we spoke a few minutes ago, we find valuations by and large in certain sectors like consumer staples, maybe some IT names or pharma names, to be fairly fully valued. At the same time, there are few other sectors and few other stocks where we find pretty good opportunities, and we invest in those names.